And I'm a Regulatory Policy Advisor here at EFAMA. Today, I'll be your moderator for this session on the ELTIF 2.0, what you need to know and what to expect going forward. We will start this session with a keynote speech recorded by our Director General, Tanguy van der Werf.
Good afternoon, ladies and gentlemen, dear colleagues. Having back-to-back meetings in London today, I am unable to join you live for this important webinar. This intervention has therefore been pre-recorded. We are delighted to welcome you to our event, ELTIF 2.0, what you need to know and what to expect going forward. We are running this webinar together with Arendt on foot of our recently published ELTIF FAQ document, which you can find on the EFAMA website. The long-awaited new ELTIF regulation has entered into application in January of this year, following 2 years of detailed review by EU lawmakers. The revisions aim to make the ELTIF a more effective tool to deliver on its twin aims, which are first to channel capital into the real economy to support long-term projects, such as, for example, social and sustainable infrastructures and Europe's SME sector. And second, to democratize access to private markets, recognizing retail investors' increasing appetite for exposure to asset classes with higher return expectations and providing them with a safe, regulated product to do so as part of their long-term investment goals. Since the review was announced, we have seen major growth in the ELTIF sector as compared to the first 6 years of this product's existence. The number of ELTIFs has doubled from 57 ELTIFs in 2021 to over 100 ELTIFs today, with assets under management jumping from 2.7 billion euros to an estimated 13.6 billion. We also see new domiciles emerging, as well as new asset managers entering this space. We expect these figures to grow even further once the final piece of the puzzle has been put in place, namely the Level 2 rules, which we expect will enter into force by the end of this year. These Level 2 rules will set out important provisions regarding, among other topics, redemption terms, which will impact also on the portfolio composition of the fund. We greatly commend the thorough attention given by the European Commission and by ESMA in ensuring that these rules are well calibrated to support the goals so to be achieved by the regulation. Once the full rulebook is in place, they will represent a key mechanism for mobilizing capital to finance projects such as transport, sustainable energy generation or distribution, and new technologies. This afternoon, we will have the opportunity to receive an overview of the key revisions to the regime and how these will make the ELTIF a more attractive and effective product. We will also receive an update of where we are with the Level 2 rules and their significance to the success of the new regime. Without further ado, I will now give the floor to my colleague Gwen, who has been very actively working on the ELTIF review and who has done a fantastic job engaging with members and policymakers to ensure a workable framework.
So this afternoon, we're fortunate to be joined by Stefan Stetter, who is an expert in the ELTIF and partner in the investment management practice in Arendt. Stefan specializes in regulated and unregulated investment fund work. advising clients on the structuring and lifecycle management of alternative investment funds. He's one of the firm's experts on ELTIFs, and we are grateful to have him with us today. We chose this particular moment to hold this webinar as we're currently at a very interesting juncture in the revised ELTIF regime. This afternoon, we'll learn about the features of the new ELTIF regulation, which entered into application earlier this year, as well as what we can expect from the pending Level 2 rules. We will hear about how those rules have already created quite a stir in the market, and also discuss the next steps that member states can take at the national level to better support this revamped product. This is an interactive webinar, so we very much welcome your questions in the Q&A function, and we'll do our best to answer. So to start off, Stefan, welcome, and could you please set the scene a little bit for us? The ELTIF was first created in 2015 to serve a specific purpose, and the European Commission decided to revamp it 6 years later in 2021. So you can tell us maybe what is the ELTIF and what is its significance for the European economy and for investors?
Sure, Gwen. Dear ladies and gentlemen, please let me also welcome you to this webinar. I would like to say thank you to EFAMA for all the efforts which have been invested in the evolution of this topic and the education around ELTIFs, including the FAQ document mentioned by Tanguy. It's really exciting to see that there's such a huge interest in ELTIFs, which was considered to be a niche topic years ago. But now let's start. An ELTIF, or in its full version, a European long-term investment fund, is a special category of an alternative investment fund or compartment thereof, which allows to extend the AFMD marketing passport regime, which is normally reserved to professional investors, also to retail investors. The EU retail passport is the main reason why asset managers opt for the ELTIF regime. Just a reminder, the distribution of private funds in Europe was traditionally only possible on the basis of private placement when it comes to the retail distribution. This means it was required to analyze 27 jurisdictions, and some jurisdictions, such as France, did not allow or do not allow for private placement of cross-border retail alternatives, which means that it was required to launch dedicated structures in the relevant jurisdictions. Since 2015, the time has changed, and the AFMD marketing passport has been extended to retail investors to the extent that the relevant fund qualifies as an ELTIF. The political purpose of the ELTIF regime is to channel, as Tanguy has mentioned, financing into the real economy, but also to democratize the access to private assets, which is traditionally reserved to more sophisticated investors. If we look to the statistics, we can see that there was indeed a limited uptake at the beginning. In 2021, there were only 57 ELTIFs, with a small number in terms of assets under management. The main hubs for ELTIFs were Luxembourg, France, Italy, and Spain. For the distribution, it is France and it is Italy. The numbers have more than doubled. And in June 2024, there are now 119 ELTIFs, either as standalone funds or as compartments thereof. Luxembourg, with currently 80 ELTIFs, remains the leading hub for ELTIFs when it comes to the pan-European distribution, which means that they are distributed to more than 10 countries on average. In terms of strategies, most ELTIFs follow actually a private equity strategy, but we find also private credit, infrastructure, real assets, and a lot of mixed structures, including nowadays also fund-of-fund structures, because it is possible under the new regime to have, under certain conditions, also fund-of-fund investments. Initially, managers launched closed-ended ELTIFs, but now the time has changed and managers look for a certain sophistication in the product because retail investors need liquidity and they need to meet the liquidity demands with the semi-liquid products.
So, as mentioned, the new regulation entered into application earlier this year. However, the full regime has not yet been finalised, as we're waiting for the Regulatory Technical Standards, or RTS, to be finalised. Could you please give us an overview of where we are and what is the role specifically of these RTS?
Sure. The new ELTIF regulation, so the ELTIF 2.0, entered into force on January 10th this year. There are several ELTIFs which have been already launched under this new regime, and it's very good to see this. Some managers have, however, decided to wait and to make use of the grandfathering option, which is also foreseen under the new regime. So actually, to the extent that the ELTIFs are still marketed, it is possible to comply with the new provisions by January 11 in 2029. If the ELTIFs are not anymore marketed, there will be an automatic type of provision which makes the new regime to be deemed to be compliant by such a date. It should be noted that the ELTIF regime at level 1, so the ELTIF 2.0 regulation, is only one layer, and it is complemented by a second layer, the so-called regulatory technical standards, which are at the moment under discussion, and which deal with 4 key topics, mostly about derivatives, the life of an ELTIF, the exit provisions, as indicated redemptions and matching, and the cost disclosures. And the regulatory technical standards are currently in draft form only. They were initially drafted by ESMA in December last year, and they put a lot of work in it. The first draft was amended by the European Commission in March this year. ESMA has published its final opinion then in April this year, and currently the draft RTS are finalized, and they will be very soon sent over to the European Parliament and Council for a 3-month scrutiny period. All going well, as indicated, we could see potentially the text to be finalized and to be adopted later this year, Q3, Q4, depends a little bit on the process. And it would be my understanding that the RTS will govern the ELTIFs being subject to ELTIF 2.0, and that in case of any doubts, the RTS will need to be interpreted also in line with the level 1, so in line with the ELTIF 2.0 regulation, which aims to provide more flexibility on the asset, investor, and operational side.
Thanks, Stefan. And so we'll dive a bit more into the content of these RTS later in the session today and why maybe they've been a bit contentious. However, before we do that, I think it would be most useful if we have an idea of how the ELTIF works overall. So perhaps you could begin by telling us a little bit about the investment requirements of the ELTIF, starting with which categories of assets the ELTIF is allowed to invest in.
Sure, with pleasure. ELTIFs have 2 pockets of eligible investments. On the one hand, there is a liquid pocket, and an ELTIF must invest at least 55% in such pocket. On the other hand, it is possible for ELTIFs to invest up to 45% into liquid assets. And this is in particular important whenever you set up a semi-liquid ELTIF, because semi-liquid ELTIFs, in this respect, redemptions may be only served out of the liquid portfolio, and therefore you need to have a robust liquid portfolio in order to run such a product. On the asset side, for illiquid investments, it is possible to invest in private equity, private debt, mezzanine, loans, real assets, and it's possible to invest in simple, transparent, and standardized securitization, green bonds, and a very important point, also in fund of fund, to the extent that they comply with certain conditions. The liquid pocket is basically a sort of a usage pocket, which includes listed equities, bonds, money market instruments, or investments in other usage. And it should be noted that ELTIFs do not allow for some sort of speculative transactions, as we can find them sometimes in the usage field when it comes to with a very short character, such as short selling, investments on a high level basis in derivatives to the extent it goes beyond the pure hedging, or short-term commodities. It is possible for ELTIFs to borrow in cash to the extent ELTIFs are marketed to retail investors. The limit is 50% of the net asset value. And it is possible, however, to go beyond the 50% whenever you exclusively market to professional investors. ELTIFs need to comply with some risk diversification rules, and the rule is at 20% and 10%, 20% for illiquid investments, 10% for liquid investments. And in case of fund-to-fund investments, the concentration rule of 30% must be met.
Fantastic. And some of these asset classes are involve the use of a so-called qualifying portfolio undertaking. So perhaps you can give us an overview of what is a qualifying portfolio undertaking for the purposes of the ELTIF regulation.
Sure. A qualifying portfolio undertaking is actually an entity which fulfills three criteria. First of all, it must, in principle, must not be a financial undertaking. Under ELTIF 2.0, there came in a sort of a derogation which recognized the fact that sometimes it's needed to make such investment, and this is a so-called fintech carve-out. So whenever you deal with a company which has a sort of a financial character, and it is has an authorization of less than 5 years, it's however possible to make this investment. In principle, ELTIFs deal are illiquid, and therefore it is not possible in principle to invest in a listed company unless such a listed company has a low market capitalization, meaning below a threshold of 1.5 billion euro or its equivalent. And an ELTIF invests typically in the European Union, but it can invest also beyond. And in this case, you must make sure that this is actually a country. The target country is actually a country which is cooperative from on the anti-money laundering and also on the tax reporting side. And just to make it clear, ELTIFs can invest worldwide, and there is no minimum exposure whenever it comes to investments in the European Union. There is a specific case only when it comes to fund-of-fund investments.
Okay, and so that's an overview of the assets that an ELTIF can invest into. The question then is, can ELTIFs invest indirectly into these assets? Maybe you can give us an idea of that.
Yes, as other alternative investment funds, ELTIFs can invest directly or indirectly on a co-investment basis with other parallel funds. And recital 12 of the ELTIF regulation is there quite clear, because it allows for investments to be conducted through intermediary vehicles. And it also clarifies that minority co-investments may be conducted. This means an ELTIF may be easily integrated side by side of other funds of the same manager, provided that the alternative investment fund manager, so the ELTIF manager, puts in place organizational and administrative arrangements to identify, prevent, manage, and monitor potential conflicts of interest.
Okay. And so in terms then as well of how the ELTIF can structure its strategies, can they conduct a fund-of-fund strategy, and how can they have a master feeder structure as well?
ELTIFs may follow a fund-of-fund strategy, and this is now explicitly recognized by Article 10 of the ELTIF regulation, but subject to certain conditions. One condition is the target fund must be based in the European Union. Then such target fund must be managed by an EU alternative investment fund manager. The target fund must also invest in eligible assets. You remember private equity, private debt, loans, real estate. And the target fund itself should not have a fund-of-fund strategy, because it was not intended to create the ELTIF for the purpose of having fund-of-fund investment, no, the link was always, or the reasoning was always to say the ELTIF should have a link with the real economy, and therefore one layer of fund is fine, but a lot of layers of fund are not anymore compliant with this purpose. And just to say, whenever you make a fund-of-fund investment, you need to take into account the single exposure or for the diversification rule, meaning which is 20% for the illiquids, which means that when you make an investment through a fund-of-fund and at the same time you invest in such an asset, you need to calibrate correctly and to calculate that you do not have an exposure of more than 20%. And the same approach applies also when it comes to the borrowing provisions, because otherwise you would circumvent the rules. ELTIFs may be also a master fund, and this is something what we have seen in the past already, where ELTIFs based in Luxembourg, for instance, they got a feeder fund which was based in different other countries, including France or Italy, and this is not a problem at all. However, in the past, it was not possible to have actually an ELTIF as a feeder fund. This has now been clarified, and it's possible to have an ELTIF as a feeder fund, provided that the master is also an ELTIF. And this is basically the reason for this is it should be ensured that the ELTIF compliance rules apply also at the master level, and that there is basically no risk that these rules are put aside and could be ignored. Whenever you deal with master feeder structures, there are a few considerations, notably when it comes to information sharing with the depositary and when it comes to reporting to the investors, which are some operational details to be taken into account.
Thanks, Stefan. So that's a great overview of what the ELTIF is, what it can invest in, the strategies it can adopt. And then another topic is who are the target investors that can invest into an ELTIF. So the ELTIF has been described as being a bridge between the UCITS and the AIF as a way to democratize private assets by allowing retail investors to invest into a pan-European alternative investment fund. So could you, Stefan, please tell us who can invest in an ELTIF and what conditions do retail investors have to satisfy in order to access this type of fund?
So an ELTIF, when it comes to the distribution or to the marketing of such product, it is absolutely fine to market to professional investors as for any other type of alternative investment fund. And the main goal of an ELTIF is, of course, that you extend this passport so that you can also market to retail investors, which is for basically most ELTIFs the case. If it is intended to market to retail investors, it will be required to perform a suitability test of the relevant investor. This means you need to check, does the investor have the required knowledge about the product? Does the investor have the required financial means? And can the investor basically suffer the losses resulting from such investment? There is no minimum ticket size, as it was before, the relevant 10K rule, and there is no maximum investment size when it comes to the previous rule, for instance, which set out a rule of 10% cap, which was a maximum exposure of the private wealth of an individual investor. This doesn't exist anymore, and so it is much easier on the marketing side to reach out to investors, provided that the relevant AIFM or the distributor are performing the MiFID test.
Okay, and so those are the additional safeguards that we have in place where an ELTIF is marketed to retail investors as well as professional investors. But where we have an ELTIF that's sold only to professional investors, there's some additional flexibility that exists for those type of ELTIFs.
Yes, the ELTIF regulation is pretty smart in this respect because it contains actually some provisions which are for retail marketing and some provisions which where you can derogate when it comes to the professional only marketing. And in this respect, it is possible, for instance, if you limit your target audience of investors to professional investors, then you can derogate from the risk diversification requirements. So you do not need to respect anymore the 20 or the 10%. you can derogate from the concentration rules. You will be also it will be also possible to derogate on the borrowing rule side. You are not anymore limited to 50%, but you can go up to 100% of the net asset value. There is no suitability test to be performed, and you do not have the so-called cooling off period, which is a period where the investor, the retail investor, may withdraw free of charge whenever they reconsider their investor. This doesn't apply actually for professional-only investors, and it is possible to derogate from the rule of equal treatment, which makes sense because the professional investor segment knows more the rule of a fair treatment. Why are professional ELTIFs set up? Well, the reasons may vary, but what we see is that in some cases the reasons are regulatory driven, because some institutional investors need to invest in a regulated product, and there the ELTIF as a regulated product is a perfect candidate. Some sponsors looked for an elegant way of having a loan origination regime because they have faced some discussions in some member states, and there the ELTIF regime is actually very helpful because it contains a written regime where the sponsors can rely on. And in the future, the ELTIF may be interesting from a Solvency II point of view. As you may know, there is a reform in the making of Solvency II, and this contains also a paragraph about the possibility to reduce the own fund requirements whenever there is an ELTIF as a target fund. And this means in practical terms that the Solvency II investor can invest more money in a product than it could in a comparable product, which is not an ELTIF.
Thanks, Stefan. And given now that these funds are open as well to retail investors, this might give rise to some interesting distribution considerations. So are there some specific considerations that managers should bear in mind when they're distributing and marketing their ELTIFs?
Yeah, it is correct. I mean, when you look on the operation and distribution side, that when you deal with retail investors, it may potentially be challenging to come up with a commitment model which is much more a model from what you see on the sophisticated investors, and it's much more common to have a fully paid-in model where the relevant subscription amount is immediately paid by the investor, because retail investors do not really like to have some pending commitments over a period of 2, 3, 4 years. I know that in some cases on the operational side, there are some discussions about how to mix actually in the same product the so-called commitment and the capital call model and actually the fully paid-in model. And so far, I'm not aware that anyone has put this in place, even though it's legally possible, because to the extent that you comply with the ELTIF regulation and that you apply some considerations, I do not see a reason why this shouldn't work. But of course, on the operational side, it's also something to be discussed with service providers. As ELTIFs have been initially designed as closed-ended products, it must be possible to transfer actually the shares or units of an ELTIF to another investor, provided that the relevant investor meets the eligibility criteria. And the ELTIF documents may not prevent an ELTIF from being listed. And to the extent that there are any transfers from one investor to the second, so sort of a secondary deal, it is actually required to deal with a suitability test also at this level. And this means in practical terms that you involve, whenever you have such a secondary transfer, also either the manager or the distributor in order to perform such a test. On the retail protection side, we should note that there are several transparency rules to be complied with. So the ELTIF prospectus is not a simple IEF type of prospectus. It contains more information, which is laid out in the ELTIF regulation. And this includes also the requirement to produce a PRIPS kit. Again, retail investors have a period of cooling down or cooling off, and whenever you deal with retail investors, take into consideration that they may withdraw within 2 weeks, and they may not reconsider, so that from a practical point of view, maybe it makes sense not to immediately invest the money received from the retail, but maybe to wait or to put it on a sort of an escrow account.
Thanks, Stefan. And so, in addition to that, the new rules also made changes to when an investor can decide to exit the fund, which will make the ELTIF more practical and more attractive to investors, in particular retail investors. Perhaps you could give us an overview as well of the new redemption provisions.
Sure. So most ELTIFs under the previous regime were closed-ended. But Article 18, paragraph 2 has already allowed in the past to provide for the possibility of early redemptions. And only a few made use of it in the past. And now we can see that there is more and more appetite around this semi-liquid provision. And if you read Article 18.2 in its new version, you see that there are a number of conditions which must be actually met. And the first requirement is that there is not a possibility so in principle, it's not possible to redeem during the ramp-up period unless the manager provides for a minimum holding period, which to a certain extent can be shorter. At the time of the authorization and throughout the entire life cycle, the manager of an ELTIF, so the AFIM, needs to have in place redemption policy and adequate procedures which are consistent with the illiquid nature of an ELTIF. The redemption policy must clearly set out the procedures how to operate the redemptions, because it must be transparent for the relevant investors. And one important item, as indicated, an ELTIF may only serve the redemptions out of the liquid portfolio. And so it's not possible technically to sell some of the illiquids in order to serve redemptions on the it must necessarily be served out of the liquid portfolio, and this requires actually to have a liquid portfolio. And the investors, whenever the liquid pocket is too short, need to be treated fairly, and in some cases, if needed, need to be served on a pro rata basis.
Stefan, and yeah, these conditions are going to be fleshed out further. But in addition to these terms that you've set out, we also have the matching mechanism as another way for investors to exit the ELTIF. So maybe you could run us through that a little bit as well.
Sure. In addition to the redemptions, as you have indicated, there's also a description in the ELTIF regulation of a sort of a transfer mechanism, which works in a way that an existing investor, whenever he or she asks for a redemption, will be replaced by a new joiner, a new subscriber, and in this way, this we call matching under Article 19.2a of the new ELTIF regulation, and this is an elegant way because you avoid any variations in the commitments of the ELTIF, and in this way you remain neutral. Which is obviously for some managers much easier to accommodate when it comes to liquidity management, because you do not have to in a certain way to serve out of the liquid pocket, because it is an event which remains on the commitments neutral, and it doesn't apply all the requirements foreseen under Article 18.2. So theoretically, a matching is also possible from the beginning. And you do not need to put in place a ramp-up period, or you do not need to exclude the possibility of matching during the ramp-up period, or you do not need to put in place a minimum period. However, the matching is also subject to some conditions, and in this respect, it is required again to have a policy in place, because it's good practice and it's also important to follow a certain procedure in this respect. And this matching policy needs to foresee how the transfers are processed, who is in charge of the process, is it the A firm or the administrator, then what are the rules for determining the execution price, and is it and notably how is also the relationship when it comes to matching and redemptions. So because it's not intended to create a certain arbitrage between the two, which could lead to some frustration on the investor side. And in this respect, it should be it's also clear that any fees, costs, and charges should be clearly communicated to the investors. And this is now, and again, the requirement of treating the investors fairly. The rules around redemptions and matching are further detailed in the draft regulatory technical standards, which are currently being finalized.
Stefan, and I think it's a good time so for us to move on to actually dive. So as we've mentioned, those are currently being drafted at the moment. And as mentioned already, those level 2 rules are going to set out additional detail regarding the use of financial derivative instruments for hedging purposes, redemption conditions, the conditions in which the life of the ELTIF will be considered compatible with its individual underlying assets, the matching mechanism, as Stefan just mentioned, and rules around cost disclosure and methodology. Most attention has been given to the provisions regarding when and how an investor can exit the fund. So before we dive into the details of those specifically, perhaps you can recap, Stefan, where we are with the process of the regulatory technical standards.
Sure. The RTS, or the regulatory technical standards, are currently in draft form, and we are on the finish line. They were initially drafted by ESMA in December 2023, and then the first draft was amended by the European Commission in March this year. ESMA has then published its final opinion in April, and as again, we are now at the finish line and expect that the draft document will be sent over to the European Parliament and the Council for the 3-month scrutiny period. And if everything goes well, we could see the text later this year, adopted Q3, Q4, and then we have sufficient clarity also on this side, and I think this will help the take-up of ELTIFs.
Thanks, Stefan. And so in terms then of the details, as you mentioned, ESMA's first draft was tabled in December of last year, and then its second was in April of this year. So could you tell us maybe the gist of ESMA's first draft with respect to the redemption rules and what changed in its second draft of April this year?
Yeah, the regulatory technical standards, which were initially drafted by ESMA, contained a table in order to calculate the minimum liquidity to be maintained when allowing for redemption. So the minimum liquidity in terms of the liquid pocket, so the maximum 45% when it comes to the determination of the two packets of on the ELTIF side. And these liquidity terms were extremely focused on the notice period. And you saw there a sort of requirement which increased or which decreased longer the period, less minimum liquidity was required. And the operational difficulty, what based on our discussions with the asset management industry, was that unless it was contemplated to provide for a very long notice period of more than 6 months, the table has actually referred to a minimum liquidity which was difficult to operate on by the asset manager side, because they are typically operate with a much shorter period based on other products, what they have launched. And typically you see like redemption notice period of 30 days to maximum 90 days, but it's rather uncommon to operate with 6 months plus or even 1 year. The amended draft, if you look then what came out by ESMA, granted more flexibility regarding the minimum liquidity. However, several asset managers have indicated that it's not really how they think about the product. They consider this product to be a semi-liquid product where they would prefer to refer to the redemption frequency. So if this is monthly, quarterly, yearly, rather than focusing too much on the notice period, as this corresponds actually more to their operational model. And this is again one of the discussions which we have seen a lot around the ELTIF topic. Whenever there is a requirement to think things differently, then this triggers operational discussions within the asset manager, increases the administrative burden, and increases automatically costs because you need to apply a special process. Ideally, asset managers would like to apply a similar regime as they already know, and they are used to the model where they think around redemption frequencies and not notice periods.
Okay, thanks, Stefan. And so those were ESMA's two drafts from December and April. And in between those two drafts, the European Commission, you mentioned, tabled its own version of how the redemption rules should work, which ESMA marked up in its set. So how was this Commission vision different to ESMA's version, and what was industry's response or view on the different options?
So the amendment suggestions, indeed, when they made by the European Commission, they have taken into account the specific nature of an ELTIF as a semi-liquid product with illiquid assets, and which contains, to a certain extent, its own protection mechanism. As redemption requests, again, may be served only out of the liquid pocket, so there is not really a risk of a sort of a run on the illiquid assets. A semi-liquid ELTIF is basically a product which, unlike a UCITS, and I think this is sometimes where a lot of discussions or misunderstanding may come from, does not intend to offer a maximum liquidity, but it's a product which is designed to provide stable returns, and an exit is supposed to be an event which occurs less frequent. Taking this into consideration, it makes sense to refer actually to the redemption frequency as an important element to determine the liquidity, whereby it's possible to aggregate also redemption caps over 2 months. And this is what we have seen. The European Commission made references to the redemption frequency, and one of the options what have been suggested was actually the possibility to come up with a sort of aggregation mechanism. The EU Commission again has understood that ELTIFs are tailored products and which are designed for different investment strategies, and in some cases also for an heterogeneous investor base, because this product has a lot of diversity in it. It is not like in some UCITS where you follow a similar strategy for listed equities or bonds. It is an alternative product where one private equity product can completely look different than another private equity product, and may have a completely different target audience. And from this point of view, it is required for ELTIF managers to adapt on a case-by-case basis their strategy and perhaps the flexibility around this topic.
Thank you, Stefan. That's fantastic. So now we've received a very good overview of the regulation which just entered into application and what we're expecting from the missing piece of the puzzle, the level 2 rules, which we hope will enter into force. We expect will enter into force by the end of this year. Another piece of the puzzle is taxation and national incentives. This is something that was highlighted, for example, in the recent Enrico Letta report, which mentioned tax breaks and other incentives at the domestic level will be crucial to promoting the ELTIF. Is there a form of EU harmonisation which could ensure a level playing field when it comes to tax treatment of ELTIFs? And what are member states doing to facilitate the take-up of the new ELTIF regulation?
So the ELTIF regulation does not itself establish a uniform EU tax treatment that is applicable to all ELTIFs. And actually, it is required to analyze on every member state basis to whether a sort of a product, because the ELTIF is a label, so it's typically added to a sort of a product, whether there are some incentives which may be put in place. And some of the member states have been active, and one good example is, for instance, Italy, where investments in ELTIFs that meet the sort of requirements of an individual saving plan, and it provide Italian tax resident investors with a statutory exemption from capital gains, which is normally 26%, and inheritance tax. But in order to qualify for such an exemption, investors must maintain a minimum holding period of 5 years, and they need to make investments within specific thresholds. So it's not possible to go beyond a certain amount. But this is one example where an investor may have an actual benefit from investing in an ELTIF rather than investing in another product, but this is country specific. Another example, which is also country specific, is France, where ELTIFs which are put or designed as part of an insurance wrapper, so actually the insurance is investing in, and to the extent that this product is held for more than 8 years, there's also a sort of a tax advantage treatment, which is something where, if you look into some of the current initiatives at European level, which could maybe an inspiration for some of the other countries. Spain is a good example, because there are certain regions applying special tax regime for ELTIFs. The only downside of this is, of course, you create within the same country a sort of a competition. And then the question is a little bit to which extent is this a system which is reliable for the entire country. If we look to the future, we can see that there are clearly some initiatives which aim to make the ELTIF label more attractive. And in this respect, as I've indicated earlier, we have the reform around Solvency II, which provides for a lower capital charge to be kept at the level of the Solvency II investor in case the relevant investor invests in an ELTIF. And in certain cases, it will be possible to reduce actually the charge from 49% to 22%, which means, in a nutshell, that the Solvency II investor may invest more cash in an ELTIF compared to an investment in a non-ELTIF. But also the recent letter and Noyer reports request to actively involve the ELTIF in order to create and enable a savings and investments union, which will potentially require member states to provide for more attractive tax regimes for certain products, including the ELTIF, in order to ensure the funding of the financial needs of the European Union. The outlook, from my point of view, for the future of the ELTIF seems to be very positive. The amendments under the ELTIF regulation have been welcomed by the asset managers industry, and now it's important to keep the same drive actually for the regulatory and technical standards and to bring it positively over the line.
So much, Stefan, for this very interesting overview, very comprehensive overview of the regime and potential actions that national member states can take to support the implementation of the new regulation. Any further detail as well can also be found in a joint Arendt FAQ, which is available on the IFAMA website at the moment as well. So I think at the moment we'll have some time for questions, if that's okay. We have quite a few that came into the chat and into the Q&A function, so I'm going to try and pose a few of them and get to as many maybe as we can. The first, Stefan, is to do with fund-of-fund strategy. So if somebody would like to clarify whether the fund-of-fund strategy for ELTIFs can only work for a closed-ended ELTIF, or is it possible to have it work for open-ended ELTIFs as well?
So fund-of-fund strategies, yes. I mean, so there is no limit on the asset side, which on the ELTIF regulation says that you can only have a fund-of-fund strategy as an ELTIF to the extent that you are a closed-ended ELTIF and that you do not allow for redemptions. From a legal point of view, if you look to the regulation, it is absolutely fine. The question is, of course, in some cases, does it work from an operational case if you, as a fund manager, then have like investments only in closed-ended funds? Because again, to the extent that you are making investments as a semi-liquid ELTIF, you need also to keep a liquid pocket. And so from this point of view, to the extent that you invest, of course, in investment targets which are not subject to the liquid portfolio, then you need to create actually a liquid portfolio to keep it possible.
Thanks, Stefan. And again, on investments into other funds. So somebody has asked, where an ELTIF wants to invest in an EU AIF managed by an EU AIFM, does 100% of the underlying assets of the target AIF need to be eligible assets under the ELTIF regulation? Or can it also hold assets that are ineligible under the ELTIF regulation to be a target fund of the ELTIF?
So from my point of view, if you read the text in the relevant ELTIF regulation, it is indicated that the ELTIF that the ELTIF may invest in EU AIFs, which invest itself in eligible assets, but it is not clarified that this must be always in 100% the case. To a certain extent, it would be my understanding that you can have a certain indirect exposure to non-eligible assets, but of course, in this case, this may not qualify for the 55 or 45% of when it comes to the asset allocation. So it is my understanding that there is a certain possibility, but there is at the same time a discipline to be kept, because you need to meet your minimum 55%. And if you have funds which are with a sort of the majority of investments in it, then this does not work because you do not comply with the 55% at least.
Very interesting. Another question that's come through has been the interaction with UCITS funds. So the question is whether you would think that an ELTIF could be an eligible investment for a UCITS fund to invest into, and what the conditions could be. So the example that they give is if the shares of a closed-ended ELTIF might qualify as transferable securities and be acquired for the UCITS if, for example, the shares are listed on a stock exchange. I'm not sure if you have a view on that.
Well, just to say, it's a very interesting question. I would prefer if you bring me in contact with the person after because I would like to speak also with my UCITS colleagues about this topic.
It'd be an interesting topic to discuss under the context of the eligible assets review, which ESMA has asked for input in over the course of the next few months as well. Just checking as well any further questions that are coming through. So one person has said, given that the ELTIF regulation is not a directive, is it possible for the member states to still apply minimum portfolio or holdings for distribution to retail investors? They say that there's a rumor that the Greek authority is still applying a minimum threshold of 100,000 for retail investors, but they don't think that that's possible given that it's a regulation, so minimum harmonization.
Yeah, so from my point of view, I mean, the regulation applies everywhere directly, so there's no margin for a different approach. So from this point of view, the distribution needs, or the assessment relies exclusively on the suitability. It could be that that if it's still an ELTIF 1, then of course then you apply still the distribution rules around ELTIF 1, because it is not the case that you have here now sort of a partial application only by the mere fact that ELTIF 2.0 came out. It is still a distribution regime which is linked to the product. So if you are still under ELTIF 1, you still need to comply with the rules for the distribution under ELTIF 1. To the extent that you have an ELTIF 2.0, you can benefit from the more flexibility in this respect.
And just another question as well, regarding the suitability assessment for retail investors and who's responsible for carrying out that suitability assessment. So this person has asked whether the fund manager would be responsible for carrying out the appropriateness assessment, or is it a third-party distributor where that distributor is appointed?
This depends a little bit on the operation and model which is run. In most cases, the AFM is typically delegating this to a distributor, but of course the AFM has a sort of a responsibility to overview and to make sure that the distributor is actually performing this. So typically you enter into a distribution agreement and then you will fix the details, you will put in the obligations of the distributor, and one of the obligations would be to perform the suitability test. But you need to receive also information about it, reportings, and from this point of view, you check the due diligence, also the operational setup of the distributor. So there is sort of an oversight obligation for the AFM, but in practical terms, it is a matter of fact that the distributor deals with it because they are having much more human resources than some AFMs may have.
Makes sense. And perhaps another question that's come through, a clarification. So whether the AIFMD provisions apply on top of the ELTIF regulation.
It's an excellent question. I understand that to a certain extent. I mean, there's an overlay. I mean, an ELTIF is an alternative investment fund, but at the same time, the ELTIF provisions may provide for a lex specialis, so a special type of regime. And in this case, they may go either further or more flexible, whatever is more specific. So for me, it's not a general application of an automatic type of approach. It's more case-by-case analysis. Is there a specific provision, and if there is nothing ruled in the ELTIF regulation, then would be my understanding that the IFMD to this extent applies. But if there are specific rules, then it would be my understanding that there the ELTIF may actually be considered as a lex specialis.
Do you want to take another question? Do you think we have time for one more, or?
If you have, yes, with pleasure.
One more that I think two separate people had asked. So they had asked whether a MiFID II license is necessary to distribute an ELTIF.
It's so if you look you need to have, if you want to distribute an ELTIF in the relevant countries and you have a distributor, you need to have the relevant licenses in place. So yes, but if you go actually for the retail, because you need to perform the suitability test.
Correct. I'm just double checking through. I think that I've gotten to all of the questions. There were quite a few that came through, so hopefully we answered all of your questions. And if not, please do feel free to be in touch in any case. And as we mentioned already, feel free to as well refer to the FAQ document, which we co-published with Arendt earlier this year as well. So I think in that case, we can perhaps wrap up the session for today. Thank you so much, Stefan, for your expertise and for sharing your inside knowledge on the topic this morning. And thank you so much to everybody who took the time to participate and to attend the webinar this morning. I hope you have a very nice rest of the day as well.
Thank you. Thank you. Bye.